Hi. Let's learn about fixed interest rates. A fixed interest rate is an unchanging rate charged on a liability, such as a loan or a mortgage. It might apply during the entire term of the loan or for just part of the term. For example, if you have a fixed interest rate of 4% on a 30-year mortgage, that rate will not change throughout the life of the loan, no matter what happens in the economy. This means your monthly payment remains the same for the entire mortgage term. A fixed interest rate is attractive because it provides predictability. This means you won't have to worry about your interest rate or monthly payments changing, even if interest rates in the economy increase. It's like locking in a low price for something and being protected from price hikes in the future. Fixed rates are typically higher than variable rates, but they are beneficial when interest rates are low. You can easily calculate your overall borrowing cost with a fixed rate, which makes it easier to budget and plan for other expenses. Calculating fixed interest costs is relatively simple. You just need to know the loan amount, the interest rate, and the loan term in years. You can use online calculators and tools to help you determine the total interest you'll pay over the life of the loan. Remember that your credit scores and income can influence the rates you pay for loans, whether you choose a fixed or variable rate option. The main difference between fixed and variable interest rates is that fixed rates remain constant throughout the loan term, while variable rates can change based on the interest rate environment. For example, if you have a 5-to-1 hybrid ARM, you might have an introductory rate of 3.5% for the first 5 years, after which the rate will change periodically. Fixed rates provide stability, but they can also be higher than variable rates. Variable rates may initially be lower, but they carry the risk of increasing over time. Fixed interest rates offer predictability and allow you to budget for the same monthly payments for the entire loan term. This can be beneficial when interest rates are low because you can lock in a favorable rate. However, fixed rates can be higher than variable rates and may not be the best option if interest rates are declining. Refinancing a fixed-rate loan can also be time-consuming and costly. Borrowers should weigh these pros and cons when considering fixed-rate loans. For example, if you borrow $30,000 at a fixed interest rate of 5%, your monthly payments would be $566, and your total interest paid over the loan term would be $3,968.22. In the case of a $300,000 30-year mortgage at 3.5%, your monthly payments would be $1,347, and your total mortgage costs with interest included would come to $484,968. Fixed interest rates keep your payments consistent, allowing you to plan and budget for expenses accordingly. Fixed interest rates remain constant throughout the lifetime of the loan, providing borrowers with the assurance of consistent monthly payments. This predictability allows you to budget for other expenses and plan for saving. While you might miss out on lower rates when interest rates decline, you are also protected from higher rates if interest rates rise. The main difference between fixed and variable interest rates is that fixed rates remain constant, providing stability and predictability. Variable rates, on the other hand, can fluctuate based on the interest rate environment, potentially making your loan cheaper or more expensive over time depending on the rates in the economy. A fixed interest loan offers predictability and stability. Your interest rate remains the same throughout the loan term, allowing you to budget for consistent monthly payments. This type of loan is particularly beneficial when interest rates are low, as you lock in a favorable rate for the entire life of the debt. Here are 3 key takeaways. 1. A fixed interest rate avoids the risk that a mortgage or loan payment can significantly increase over time. 2. Fixed interest rates can be higher than variable rates. 3. Borrowers are more likely to opt for fixed-rate loans during periods of low interest rates. Hope this would help. Thanks for watching.